Hey everyone, I hope you guys are all having an amazing Wednesday. I am currently here at our Northwood Mortgage Head Office in Markham and just wanted to share a few things with you today. As part of my ongoing commitment to you, I had promised to keep you all up to date with regards to economic forecast, current market conditions, interest rates, etc., etc. And so for the past 6 months, I wanted to first off by apologizing for the lack of communication, the lack of educational content, simply because on January 1st, if you guys all remember, our government introduced the mortgage stress test. And as a brokerage, as the team that, we're all part of, the dream team for Northwood, we were all anticipating a complete downturn in mortgage volumes and originations. And so the past 6 months have come and gone, and we had actually the complete opposite in results or expectations. And we are also on track as a team and on an individual basis to actually have our best years ever. So for that, really none of that would have been possible without your continued support, without you continuing to spread the word and what we do to all of your close friends and family and colleagues. So thank you very much for continuing to spread the word in what I do. There's absolutely no way that I would be where I am today on a professional level without your support. So it's definitely very much appreciated. So I want to lead into Bank of Canada. And so as you may have heard by now, as a country, we expected a quarter-point increase this morning. And sure enough, that was the announcement from our central bank. So what does this mean exactly? Well, this means basically for anyone that has a variable rate mortgage, a line of credit, whether it's secured or unsecured, your cost of borrowing has just gone up as of this morning. And for example, if you owe $100,000 on a mortgage or a line of credit, your monthly carrying costs or interest costs is going to be going up anywhere between $13 to about $21, depending on how your term and mortgage is set up. So my hope is that that's not going to break the bank. And of course, many can argue the fact that, how many of us really owe only $100,000 on a mortgage, especially considering GTA prices and the higher cost of living, et cetera, et cetera. But you'd be quite surprised. There are quite a few out there that owe $100,000 or less. But of course, for the vast majority of people that live in Toronto and the surrounding area, obviously mortgage amounts have been higher because of the rising cost of living and real estate. But either which way you look at it, $300,000, if you owe that much, that means you may have an increase of anywhere between $40 to $60 a month. And if you owe $500,000, it's closer now to about $100 difference on a monthly payment plan. And so you just got to reevaluate, all right? If $100 more to your bottom line is now becoming a little bit more of a stretch, well, we need to address it, all right? So as in the past, you got to keep calm. You give me a call. We're going to work out some different strategies to eliminate that stretch. So why has Bank of Canada decided to raise interest rates this morning? Well, it's primarily because of both the U.S. and Canadian economy. We are continuing to grow as a country. Our unemployment rate is an all-time low historically. Inflationary numbers is pretty much right on target. And so to avoid inflation from rising any further, one of the ways to keep it on target is to increase interest rates. If you guys remember back in the 80s, we've had rates that had gone up to 18 to 22%. And the main reason for that was the economy was doing so well. There's all kinds of spending going on, and inflation was at an all-time high. So in order to sort of cool the economy, the only way to do it is to raise rates. And it's vice versa, right? In 2008, when we had the last recession, it wasn't doing so well. So how do we encourage people to spend? Well, guess what? One of the ways is to reduce interest rates. So now that we are in an increasing rate climate, sure, it does have an impact on our bottom line, but essentially what it means is that our economy is growing and is continuing to do well. So at this particular moment, yes, is it going to impact our bottom lines from a financial perspective? Absolutely. So if you're feeling the pinch, if you're saying that, the variable rate mortgage is no longer something that I want to gamble or play with, then maybe it's time for you to lock in. And if you do have a fixed rate mortgage, guess what? You're not impacted as of right now. But if your mortgage is renewing any time in the next year to 5 years, there's a likelihood that rates may be higher as you renew on your next term. So as I preached over the years, if you do currently have a variable rate mortgage today, well, why not pretend that you have a fixed rate mortgage? All right, make your payments as if you had a fixed rate mortgage, and that extra payment will then now get allocated towards principal, which will mean that you're going to pay down your mortgage quicker. And so the only difference now when rates do go up is the allocation between principal and interest, and not necessarily your bottom line. So I hope I've given some good insight as far as what really happened today. If you have any questions, concerns, by all means, you're always more than welcome to reach out. And always remember, if there's any time that you have any concerns about your own financing, always remember to keep calm and call Tim Fong. Thanks so much, and hope you guys have a great day.